Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with a man who I think went 5 for 5 last week on the big tech names, Mr. Dan Bird. How you doing?
I'm doing great. And I did that only by looking at charts.
Yeah. So again, folks, if you don't believe me, go back to Dan Bird's playlist. You can look at video number 2 from last week where we looked at big tech. And he actually, just looking at the charts, called Meta, Microsoft, Amazon, Apple, and
Google.
Meta. Google. There you go. Google. Yeah. So those 5. And near as I can tell, you nailed all 5. Said Meta was going to be worst. Clearly,
I said Meta was going to be horrible.
You did. Horrible was the word you used.
I said Apple would be the best.
And you nailed that. Yep.
And I said the other ones will probably be okay, but their guidance won't be great.
Yeah, you nailed 5 for 5. So, folks, if you don't believe us, go back and watch last week. Let us know what you think, and then come back and tell us how he did. So again,
we can look at a couple of those in the next session, just to review the charts. I mean, Meta is pretty interesting.
Yeah, I actually got to tell you, I bought some Meta under $100 just because I think that good old what's his name? Why am I drawing Zuckerberg, yeah, won't burn his house down. So I bought it for like 98 and change. Not very much, but I did buy a few shares. So
yeah, I mean that's it's probably going to go sideways for a little while before it does anything.
Yeah.
But it could go to 50.
Yeah, well, you know, if it does, I lost. I'm used to losing money in stocks, so. But
yeah,
I did.
The whole metaverse is a very interesting play. I have a prediction on that. I predict that there are some major tech players, and I would say Oracle, Microsoft, Google, could be some others too, that are very quietly behind the scenes and not making any noise about it, creating their own metaverse offerings.
And then splash.
And they're going to let Facebook or Meta take the hit for the next 2 years until it's ready.
Yeah, it's going to be interesting.
So Zuckerberg was cute in naming his company Meta, thinking that he was getting out ahead of everybody. But yeah, I predict that there's going to be others that'll be ahead of him when when the dust settles.
Yeah, it'll be interesting to see. Again, not stock market advice. I just like sharing with people what I'm doing because I haven't bought stocks forever. So sure. As I shared weeks ago, I bought JP Morgan at 104 and change, I think.
That's doing well.
Yeah, it's up a little bit. And we bought some Meta, I think, I don't know. It was 98 and change is all I remember. So again, not stock advice, but I just like being full disclosure with everybody on my channel. But let's talk about next week. And I think there's 2 important things happening. There's a couple of earnings that come out that I'm interested in because they really focus on the consumer, but we obviously have Wednesday, the Fed meeting and the Fed press conference. But I actually think the most important number is going to be Friday. I think it's going to be Friday.
Yeah. Here's my newsletter. If anybody's interested in joining,
I love the newsletter.
Put it out yesterday. Just send me an email to breakpointtrading@gmail.com and I'll send you last week's and I'll add you to the list. And I brought this up because it has the economic calendar for last week and next week on it.
Oh, great idea. I love that you do this.
Yeah. I put that in every week. So you'll see what the results for last week. So here's last week's results right here.
Yeah.
And you can see an interesting one I thought was GDP. I actually talked about this in the newsletter. GDP came in at 2.6, basically wiping out those 2 negative quarters.
Yes.
So we're no longer in a recession. If you like to use that as your gauge, we are now out of a recession.
Yeah, it's going to be interesting.
I don't think we were in one.
No,
frankly.
we weren't. No, we weren't. The economists, the economic board will not declare Q1 and Q2. Again, the rule of thumb about 2 negative quarters of GDP is just that, a rule of thumb. It's a rule of thumb that's been right since 1948, but it is a rule of thumb. There are actually 4 metrics that this board looks at, and the employment picture was never even yellow, or never yellow, never red. So they're not going to call it a recession.
Yeah.
Yeah.
Right. So anyway, GDP was a big one last week. It came in positive. I mean, there's a number of reasons I think the market rallied. Some technical and some just based on the PCE came in flat.
As expected, basically. Yeah. Yep.
As expected, which is this one down here.
Yep.
So the Fed looks at that quite a bit. I mean, I think the market was relieved. It didn't come in higher,
Yes.
didn't come in lower either. But
Mhm.
at this point, bad news is good news
Correct. And that's
in the
why I
market.
think Fridays, you have it here on the right, the
Yeah.
non-phone payrolls, 200K. And again, like you said, bad news is good news is bad news. In my opinion, love your opinion. If it comes in as we did last month at 263, I think that's good news, but it will be bad news for the market, which means the Fed has more work to do. But I actually think I like guessing things just for fun. So I guessed 189 is where I think
Yeah.
non-phone. I think it will disappoint and give us hope that the Fed hits us with something less than 75 in December.
Yeah, I think it's going to come in somewhere between 200 and 263.
Okay, so you think it'll come in over?
I think it'll come in a little over the forecast.
Okay.
And one of the reasons is the initial jobless claims right here is not really going up that much.
No, it actually ticked down last week and the week before.
Right.
Memory serves. Yeah.
And the forecast is basically even.
Yep. Yeah, it
So
really could.
I think jobs is still going to be strong. I think they've got the unemployment rate here at 3.6 forecasted.
Mm-hmm.
That probably will be 3.6. Remember what I said. I got a chart ready if we want to talk about this in the next one. But I said that recessions happen usually 3 to 6 months after the unemployment rate starts going up.
Yeah, after bottoms. Yeah. Yeah.
Yeah. So we're still near the bottom. I mean, that's got to get over 4 before we're going to have a recession.
Oh, agreed. Totally
at
agreed.
least over 4.
The
The other thing too is recessions usually don't happen until 3 to 6 months after the Fed starts lowering rates.
So that talks about Wednesday. So I think generally speaking, you have it here as one of your pictures, cartoons. We're going to get 75 on Wednesday.
Yeah.
But do we get Fed pivot talk after that? Because they do a news conference after their release.
That is the key.
All
that
right.
is the key. I don't think we're going to get pivot talk. They're not going to pivot.
So let's define pivot, because the pivot's been changing. So initially, Kathy Wood and Elon Musk were talking rate cuts. I think it's fair to say that's off the table.
Mm-hmm. That is actually a pivot.
Yeah, that's a real pivot. Agreed. Then there was a new definition of a pause.
Mm-hmm.
I don't see that, meaning a Fed meeting with no rate hike. And now people are calling a pivot. They're just hoping at this point that we don't get banged with 75 in December, right? Which,
right.
Yeah.
So yeah, I don't think we will. I mean, I think everyone's expecting 50. We might not even get 50. We'll see what happens.
Oh, did I just hear you think that December might be 25?
Well, I've been saying that. I've been saying, 75, and then they might pause at that point. But I don't think the language will say pause.
Okay, so you don't. Powell can't come out and sound like a dove.
Right. That's right.
Okay. All right.
So he's going to come out. I don't think the language. I think the language might disappoint to a degree.
Okay.
Although I think that the best that the market can hope for is that he won't continue pounding the table for 75. I think he'll say, we're continuing our strategy. We plan to continue to raise rates until inflation is under control, and we will look at it meeting by meeting based on the data.
Yeah, it will be data dependent.
I don't think he's going to say we will raise rates in December. I don't think he'll say that. But I don't think he's going to say we're going to pause either.
Yeah, so this is what I expect him to say, because it's funny, we see it very differently. I expect him to say something like, we anticipate continuing to tighten or raise rates in December, although the amount may be different, or however he wants to, word that. I don't think he's going to put pause on the table.
No, he won't put pause on the table, but I think the wording will be, we will be data dependent. We will wait for the data, and we'll execute based on what the data is telling us.
So let's talk about terminal rate, because again, I think this is the discussion. When is the Fed done? I think most people are saying 4.5, and I'm saying 5. Where do you come in on all of that?
All right. So interesting. You should bring this up because I had a chart prepared.
Look at you.
Kind of busy, but I've shown this before. So I'll kind of explain the different lines on here. The blue line is the Fed funds rate. This goes back to 2002.
Yep.
So about 20 years back.
Mm-hmm.
And you can see what the rates looked like back then. So we went to 5.25 back in 2006.
Mm-hmm.
And then they left it there for a year and a half.
Wow.
At 5.25.
Mm-hmm.
And what happened right after that?
Yeah. The Great Recession.
The Great Recession, the financial crisis.
Yep.
Failure of Lehman Brothers and others. That's something the Fed's not going to forget.
No, very true.
All right. So if they, and these dashed lines here are based on what everyone's expecting. So 75 is the next one that puts it at 383.
Yeah, which is the difference, is halfway between 375 and 4. That's where he gets that number.
Right.
Yep.
So that puts it right here.
Mhm.
And if they do 50 in December, that puts it right here.
Yep.
Getting dangerously close to when we had a financial crisis.
Well, that's not true.
No, that is true.
No, you said getting
no, it is
dangerously
true.
close. No, hold
It
on.
is-
You said getting dangerously close to a financial crisis or whatever.
I said dangerously close to where we were before the financial crisis.
Okay, that's I must have missed part of that phrase. Yes.
Right.
We're getting back to a similar rate that preceded the Great Recession. Yes.
Correct.
Correct. But that doesn't mean we have to have another Great Recession.
No, it doesn't.
Okay. We agree.
But
all right.
but the Fed won't forget this.
No, it certainly won't forget it. And it's certainly going to hope the things that it's adopted since then make the system more rigid, i.e., banks are required to have more of a reserve. They can't be as levered.
Yeah, no, that's true. The banks are stronger now than they were back then. No question.
Oh, no question.
But that doesn't mean something will break elsewhere.
Oh, I agree with that. I think that's what I hope people hear in this. We're not going to get a repeat of the last crisis, meaning the banks are the breaking point. They're certainly not going to break first. Could they break? Sure. Who knows? If enough stuff breaks, it'll be outside the banking system. It'll be the non-banks or, hedge funds or private equity funds that are too levered, or somebody's on the dollar and they went the wrong way.
Right.
There will be some people swimming naked, and we're going to find them pretty soon. I just hope they're small and not gigantic.
That's what she said.
Yeah.
So anyway, this chart kind of shows what I was talking about before. These blue boxes right here, that's the amount of time from when the Fed started lowering rates until we had a recession.
So we went from 5.25 to
There's 5.25. They started lowering rates, and then we had the Great Recession.
No. Okay.
And over here, it made it to 2.35.
Yeah.
They started lowering rates, and we had the COVID recession.
Yeah, what people don't see in this is I thought we were heading into a recession in late 19, and then obviously the pandemic, just blew a hole in that scenario. Okay.
Yeah, well, we probably were. I mean, if you
I
take
think so too.
if you take the things that I've just said and apply it to 19, then yes, we were heading to a recession.
Yeah, I agree.
The Fed started lowering rates, 3 to 6 months after they start lowering rates, there's a recession. Started lowering rates here, 3 to 6 months, there's a recession.
Oh, yeah.
From the time when this red line right here is the unemployment rate.
Yeah.
Okay, this is the unemployment rate.
Yeah. So
unemployment rate was going down, down, down. As soon as it started to tick back up, we had a recession.
Yeah.
All right, right here is going down, 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 started to tick back up right there. But we didn't get a recession in here. This is when they started raising rates, actually.
Yep.
Over here, it was going down, and it's just barely just before COVID. I mean, it just took off with
Yeah.
COVID, of course,
Yeah.
but it just barely started to tick up right there. I mean, you probably couldn't even use that as a data point.
No, probably not.
But the point is, normally recessions happen after the unemployment rate starts to go up. And that kind of makes sense, because if the Fed is tightening, then unemployment rate's going to go up at some point. The economy is going to weaken, and you're going to have a recession.
Yeah.
So
do you have charts for the NASDAQ and whatnot? I'd love to see what happened in the NASDAQ.
This is actually the NASDAQ is on this chart.
Oh, okay.
So this green, blue, and red right here, that is the NASDAQ 100.
Got it.
All right. So two things. When the Fed starts lowering rates, we get a recession 4 to 6 months later. When the unemployment rate starts to go up, we get a recession.
Yeah.
Sometimes pretty quickly, and other times could take 3 months before that happens. Okay. That has not started happening yet.
No.
All right. The other thing to notice here is these little red boxes. I drew that in from the time that the rate hikes began. So the rate hikes back here started here, and the market went down 27%. From the time the rate hikes started, market went down 27%. As the rate hikes continued all the way up to 5.25%, the market went higher.
Oh, wow.
All right. Over here, rate hikes begin right here. Market went down almost 25% right after the rate hikes started. But as rate hikes continued, the market went up. The market gets used to rate hikes.
Yes.
All right. So here we are now. It's about the same time frame, about 3 to 6 months right here. Rate hikes begin right here. We hit the bottom right there. This is the NASDAQ, remember, so that's 35%.
Yeah.
And now it's been trending up.
Yeah, I think this is something that since we've been doing this every week, I'm starting to see the market clear. I've always known the market's like a leading indicator.
Right.
But something, as a real estate guy that I'm starting to appreciate because of the stock market is the market gets used to higher rates. And that's what I think is going on in the real estate market is I think people now are getting used to higher rates.
Right.
And, just putting them in the system. Cost of capital is one variable. So, and I think we're almost done. I think that's the other thing after Wednesday.
Yeah. Well, that's going to be the key.
We're almost done. Yeah.
Yeah. That's the key. I mean, I think the market is already pricing that in. I said that in my newsletter. I listed all the things that have happened over the last 2 weeks or so. We had a worse, hotter than expected CPI inflation number.
Yep.
We had terrible earnings.
Yep.
Right. All the things we talked about in the beginning.
Yeah.
Big tech companies having bad earnings. Yep. But what did the market do?
That's what I wanted to see.
Here it is right here. This is my bottom finder chart. The market was going down. Right here is where the CPI number came in, where we hit 3,500.
Yep.
And then we had not great earnings.
Yeah, and still went up.
And the market still went up.
That's crazy to think about because Apple, Amazon, I mean, these 5 names got to make up what, 30, 40% of the index?
Well, Apple, yeah, that's right.
I mean, all together.
Those 5 names make up 40%. Almost
crazy.
50%. It's like 48% of the whole index.
Yeah, that's amazing.
And most of those went down.
Yeah.
Apple
was Apple's the only one that went up. Yeah.
But the market still continued higher.
Yeah, that just tells you, it's pretty crazy.
The market's looking forward. What it tells me is that all of those bad things have already been priced in.
Yeah, it's already a known.
It's already priced in. 75 basis points is already priced in.
Agreed.
We're going to get 75 on Wednesday. If there's no explicit wording that the Fed is going to raise again at least 50, if there's nothing explicitly that states that, the market is going to take off.
I agree. Let me just ask you a crazy question. It's not what I expect, but Bank of Australia and Bank of Canada recently did it. They came in less than expected. Both of them were expecting 75 and they only delivered 50. What do you think happens in the US again, if we had a surprise Fed 50 on Wednesday, what would happen?
Well, then it's going to explode. I mean, these are the list of checks, and I put it in my newsletter. You know, actually, let me show you. This is the GDP, by the way, showing 2 negative, and we just wiped out the 2 negative quarters of GDP. This is all in the newsletter for anybody that's interested. So here's the check marks. So let's review our checklist for an end of year rally. First, I set up here, you know, all the bad things that have happened, their earnings, etc. Here's the checklist for end of year rally. Best 3 months starts on 10/28. That was Friday, by the way.
Yep, it was.
Look at Friday. This is Friday's candle.
Yep.
So what was it up? 600, 800
800
on the Dow.
Yeah.
Best 6 months starts 10/28 Friday. Check. Positive divergence as market hits a new low. Check. Put call ratio and VIX declining. Check. Price gets above 21-day moving average. Check. Price gets above 3,800, which was a major resistance level, and provides a higher high. Check. Price closes above the 50-day moving average. Check. These are all checks. Price closes above the 200-day, which is 4,100, closes above the year-to-date downtrend line, which is 4,120, and then closes above the last quad line, which is 4,200.
So let me just ask you a crazy question, because sometimes we get so certain something's going to happen that we get surprised. So let me just play the other side of this.
Sure.
We get 50 on Wednesday, which I think both of our gut reaction is the market explodes higher. But do you think there's a possibility that people look at that and go, oh my God, it's worse than we expected. The recession's closer. Because I think if people look at why we would get a 50, and again, I'm not calling for it, I'm just having a conversation, they might go, oh my God, the Fed sees the economy rolling over. What do you think about that?
That's possible. I think there's a low probability of that. I think the other side of that argument is that and this is also a negative actually, is that they say, oh, the Fed sees something's about to break somewhere.
That's one of those things.
We got another Lehman moment coming.
Yeah, we can only do 50 because that's all see what I'm afraid of is the 50 comes out, you know, the retail traders think it's a good thing, but the smart guys at Wall Street go, oh my God, we can only absorb 50. What's about to break? What's going on? So that's, again, I still think we get 75, but I just wanted to have that conversation.
Yeah, that's a good conversation. I don't think that's going to happen. By the way, here's the long-term weekly chart. Yep. So this dotted gray line is the 200-day. We need to get above that. This blue line here is the quad line at 4,200. Gotcha. We need to get above that, and we need to break this downtrend line right here. Those are the three things that were not checked.
Gotcha.
If we get above those, there's nothing holding us back from 4,800.
Okay.
There's a little bit of resistance over here around 45, 46.
Okay.
And a little bit at 43 where we bumped into it before, but 43 last time was right at the 200-day moving average. I think the 200-day is really the key. We've hit it twice here and got rejected. I think the 200-day is the key.
And that today is what, 4,100-ish?
4,100, 4,120. Yeah.
Okay. All right.
Which is also the downtrend line. I think we're going to probably get there, maybe even next week. And then I would actually like to see us have a retracement. It would be healthy for us to bounce back down and then start back up again.
Okay.
But we could bounce all the way back down to the bottom of this channel, which is at 3,200, which is another one. You know, that's a 61.8 Fibonacci level. So that 200-day is a very, very important level. And what else did I have here? Yeah, that's it.
Okay. So heading into the week, go ahead.
Anyway, what were you saying? What was your question again?
No, I was just going to do a wrap up, but go ahead, talk about the VIX.
Well, I've got a couple of other things. The VIX,
oh sure,
which I showed last week.
Really
VIX
coming
in, continuing to drop.
Yeah.
So this is my VIX chart. I had one of your listeners send me a note, and I encourage that if people have questions. I'm more than happy to answer them. He said, why do you use the 5-day and the 21-day? And why do you use an exponential moving average instead of a simple moving average? So the red one here is an exponential 5-day, and the green one is the 21-day exponential. And the question was specifically on this VIX chart.
Okay.
Because you can see where the gray crosses the red, which is the 5-day exponential. If it crosses it on the downside, that's usually near the bottom. If it crosses it as it's going up, that's usually near the top. And I drew these lines to show that. Where these things cross, see the red is the top, the green is the bottom.
Got it. Oh.
And when it turns to green right here, like it did right here, that's usually the start of an extended uptrend. So the reason I use exponential is because it puts more weight on the last few days, so it moves faster.
Yeah.
Simple moving averages takes the numbers and divides by.
Yeah, it's a little
21.
slower.
It's slow. It's a little slower. You can use either one, but the point is with technical analysis, it's really, 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 really important to pick your indicators. Don't pick too many, but pick the ones you're comfortable with and stick with them.
Yeah, you have to. Yeah, don't keep messing with them. Yeah.
So if you use simple moving averages, that's not a problem. You can do that, but don't then switch back to exponential.
Yeah, because
You
it'll tell you
need
something
to be able to look at a chart like learning French, like we talked about in the very beginning. You need to be able to interpret it right away.
Yep.
So the VIX is still looking really good, down below 27. It's almost down to 26 now. So you can see we're moving up. Here's the 200-day up here and the trend line. The put call ratio is now below 0.8. So, you know, the sellers are dissipating out of the market. The number of stocks above their 50-day moving average is taking off. That's really, really healthy. And number of stocks above their 200-day moving average, also really healthy. When this one gets below 10%, that's usually where the bottom is.
Got it.
So this is getting back to, you know, really healthy levels. And the 10-year treasury made it to 4.2, 4.3 actually.
Yeah, 4.3. Yep.
And then reversed and started coming down. In the next session, we're going to look at some different things side by side. Like we can look at the treasury next to the dollar.
Cool.
See what they look like side by side.
Awesome. I look forward to doing those comparisons.
Yeah, this is one of the reasons I think the market has been declining, actually, is because of the 10-year treasury going up.
The market's been declining?
Yeah, right here.
Oh, I see.
This whole period here, when it was going down, the 10-year treasury was going up.
Oh, no, I agree with that. I think what we were seeing for the first time in my, adult life, we really had a risk-adjusted return. I was actually considering buying bonds, right? I mean, I've never thought about doing that.
Yeah, we'll look at bonds in the next session.
Cool.
One thing that worries me though is this is the rotation indicators.
Yeah.
You know, the Qs and the technology are now below their June lows. Even as the market now has gone up higher than the June low, these are still below the June lows. So that what that means is big institutions are not yet rotating back with conviction into technology. Well, we just started the best 3 months of the year on Friday.
Yep.
So if they're going to do it, this is the time when it's going to happen.
Yeah.
So, but that does worry me right there. This is something else that one of your listeners sent me a note, and I said, you know, we're going into the best 3 months of the year. And he very astutely said, but what about the rotation indicators that you talk about? They're not looking that great.
No.
Even the discretionary versus staples is trending lower. It's going down even as the market's going up. You know, that implies that institutions are still rotating out of growth and technology.
I agree.
So we've got to watch that and see what happens.
Okay.
This is the long-term one. I showed this last week. This is when we know we are no longer in a secular bull. And we talked about the 200-day moving average, which is this pink line right here. and how throughout this whole uptrend, the market has pretty much respected that pink line, that 200-day moving average, except for the COVID crash, and it didn't stay under it very long. Last week, I said we've come down to just above it. Now, are we going to hold? And you can see what happened this week. Had a nice bounce off of it. And these indicators up here, you know, if these go below this pink line and this one here goes below 0, then we are no longer in a secular bull market. We'll be in a secular bear market. I showed this one. This is the CPI. CPI comes in December 12th or something, or I'm sorry, November 12th, something like that.
I think so, yeah. Week after next.
So that's what it looks like right now. And here's what, you know, they're basically going sideways. So the commodity and gasoline is actually ticked up a little bit. So that could mean that we're not going to see a big drop in the inflation numbers again. We might not see a big increase either, but might just be going sideways. US dollar, is it rolling over finally? Could it finally be rolling over? We're going to look at this again in the next session. Needs to get below this 21-day. And there's gold compared to the dollar right there. If the dollar does roll over and continues down, then gold might be something to buy. And there's the treasuries with the S&P. And then we talked about this one already. So that's basically what I have for the review. A lot of these things are in my newsletter. We're gonna actually look at this. This is the bonds, 20-year bonds next to the US dollar.
Fun.
We'll talk about that in the next one, and the VIX and the almanac. This almanac trader, the stock traders almanac, is really, really interesting because they do extensive historical analysis. And you can see these green lines, these green ones here. This is midterm years, which is what we're in right now. And you can see the October to March timeframe, which is right here, up 14%. November, up 14%. So the next few months during a midterm is the best time ever for stocks to go up.
Yeah, 8 days away or 9 days away.
Yeah, CPI is on 11/14.
Yep.
It's on a Monday, interestingly.
Oh.
So that's what November looks like going back 21 years. Kind of sideways until we get past the options expiration on the 18th, and then it just takes off through the rest of the year.
Very cool. Do me a favor, show your newsletter one more time, or your website.
Oh, sure.
Or email.
Breakpointtrading@gmail.com if you are interested in receiving it. By the way, something else that I want to show here. Oh, there it is. This was something that Liz Ann Saunders with Schwab posted it on Twitter, and I went and looked at some other charts too. This is the shipping rate for 40-foot containers from Shanghai to LA. This is the shipping rate. So here's COVID. Now you've heard that inflation, one of the big reasons for inflation, besides the government spending money with it that they shouldn't be spending, but one of the big reasons is the supply chain. You know, huge demand after COVID ended, no supply. And because of that supply chain, the cost for a 40-foot container shot up to the moon right here. So you can see right after COVID, the cost to ship things, see how high it went. You can see what it is right now. It's now below pre-COVID levels. This one here is kind of the same chart. Shows you the cost of a container and how it's basically just dropping off a cliff right now. This, combined with companies having too much inventory, is going to bring inflation down very quickly. And then the bottom one down here are prices compared to capacity. You know, prices usually will, this is just a straight supply and demand chart, basically. Prices will eventually meet capacity. And again, these two things are very rapidly coming together. So I just thought that that tweet was really interesting from her, that for the cost of containers, because that's really is rolled into the cost of goods that are being shipped.
Very cool.
All right.
All right. We will get ready for video number 2. Thanks, buddy.
Sounds good. Take care.